Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed right here on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me is Chris Dearborn. He's a managing director on Nasdaq's market intelligence desk. And Chris, talk about performance. It actually turned positive for the year following all the volatility that we've had due to the COVID-19 lockdown.
Thanks, Jill. Yeah, absolutely. The Nasdaq-100 index has been an outperformer because of the constituency of the index. You're seeing a lot of large cap tech names that are heavily weighted by market cap, which is the bread and butter of this index, have been outperforming throughout this environment. The sell-off was tremendous, as everybody knows. The rally for these stocks, at least, has been just as tremendous. It's almost looking like a V type of bottom end, absolutely. Year to date, the Nasdaq-100 right now is up over 4% for the year.
Yeah,
so
it's
if we
quite
look at
remarkable.
The first, it is, really. And we hopefully to see this outperformance continue, at least a little bit of a consolidation, but that's what we're going to talk about with the first chart here.
Yep, and that's exactly what I want to see from a technical perspective. Is it telling the same story as what we're seeing around the narrative of the large cap stocks that led it prior to COVID-19 are leading the way now? What's price action saying to you?
Yep. So the stock sold off significantly with the broader market. There was a fear-driven sell-off of the unknown, and we're still in that unknown pattern. However, some of the items here are starting to stabilize a little bit, especially as states and countries start to reopen. Businesses are talking future growth potentially once this gets contained. And with that is some positive sentiment by investors, as the index and its members were essentially on sale for that period in March. So looking at the first chart, you're looking at a Fibonacci retracement with the index, and it confirmed a positive move. So the 38.2 level for the Fib, the 50, which confirms the move, and the 61.8% move confirms the bullish trend in the index through the major members, and it's also traded above the 200-day moving average. Again, another important milestone for the index. Testing 9100 here, however, is a significant resistance level. That's the gap bottom from when the March sell-off started to happen, and it may be a little bit too far too fast, but the 61.8 level is held numerous times in the last couple of weeks as a support area for the index, and we're looking for the index as a whole to be range bound here for the foreseeable future between 8,600 and 9,100. A break above or below either one of those would be significant. If you break below the 61.8 retracement level, look for a very sharp, swift move back to the 200-day moving average of about 82.90. And if we manage to get above that price gap, look for the index to fill and move on to new all-time highs.
All right, if we take a look at that next chart here, what we call the heat map, we're seeing, in the top 5 holdings, 3 of those stocks that you were mentioning before that have been leading the way. Those large cap tech names that are the new economy, the modern day industrials, are leading the way today.
Absolutely. You still see Apple, Microsoft, and Alphabet up there every day. What's nice to see is some of the new other stocks participating in this rally across the board. PayPal came out with earnings, even though it was a mixed review. Investors were looking forward to their guidance and what they were talking about for the future. Stocks up over 14% now. That's adding 20 points to the index alone. And then you got T-Mobile up there as well, adding over 6 points today. What's nice to see here is that with the earnings season deep underway here, you're seeing a lot of the other stocks starting to carry the weight away from the larger cap trillion-dollar names that have been the backbone of this index.
All right, Chris, and for the remainder of the week, really busy for you guys on the desk. We're still in the thick of earnings season.
Absolutely. Even though they say 80% of the S&P 500 has reported, and it's been kind of, the guidance has been an eye-popping drop. You're down over 8%. You're kind of getting a little bit of a boost here, especially with the numbers that just came out yesterday and today. But a lot of the mid and small cap names are going to be reporting, coming forward, and that's going to be the bulk of this. The Russell 2000 index has been a laggard, even though it kind of outperformed at the end of April there. It's still been hurt for the most part. It's up about 2% today, but still well off the pace for the other indexes that have rebounded. Look for the small and mid-cap names to give you a good idea of what's moving the markets underneath. The underbelly really just isn't catching the larger cap names right here. And that divergence could lead to a differentiator for the markets as a whole and investments.
All right, Chris, thank you so much for joining us as always on Trade Talks.
Thank you, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.